Hello everyone, this is lecture 2 in a series that would be given to undergraduates who are starting a degree in banking, finance and risk. Lecture 1 was an introduction and it was actually entitled The Roots of Money and Banking and Finance, and it actually left us in a situation where we hopefully now understand exactly what money is. Before we proceed in developing an understanding of banking and finance, there are a number of terms that are commonly misused and create confusion. So what I want to do is go through those terms and explain to you the correct use so that later on in the course we have no confusion when these terms are used. And they are important and they are misused a lot by people in the industry, so do take these on board and work very hard to understand exactly what they are and how similar terms often differ quite a lot in what they mean and the context in which they are used. We finished up with the last lecture with money looking like that. That was the money supply. Originally, remember, in the middle was a little circle which was gold, and then there was credit, loans created and notes created on the gold base. Under fiat currency, that centre is cash or currency. It's the printed and minted stuff that comes from the central bank, and credit is the loans that are created in excess of that cash. And remember that of all the money used in the UK today, about 5% of it is cash and 95% of it is claims on cash, where people are using cheques and credit cards and debit cards, so other forms of payment other than cash. Now, the first distinction that I want to get clear in your mind is the difference between the quantity of money and the price of money. The quantity of money is quite easy to see. It's those two concentric circles. So the outer ring is the quantity of money. Sometimes, well, there are an enormous amount of measures of money. You'll see M1, 2, 3, 4, 5, PSL1, PSL2, the divisia, and so it goes on. There are loads and loads of different measures of money. But there are two things. There are often measures which are called narrow aggregates, which are often the bit in the middle, just measurements of cash, currency, notes and coins. And then there are the other broader measures, which include current accounts at banks and other claims on cash, which are in addition to the amount of cash that's in the economy. And it's correct to think of a broad money aggregate as a clearer definition of a quantity of money. Fairly easy. I could go out today and collect those statistics. We find from the Bank of England the total amount of cash in the system. We go to all the banks and say, what are the value of all your current accounts? Because all of those things are ready to use as money now. They make up, if you like, the monetary demand in the economy. So we could measure this as the money stock. It is the quantity of money in the economy available to use today. There's other things in the economy which are near money, and near money by definition is all those things that you'd have to do one thing to before you could make them into money. So if you had deposit accounts in banks, you can't use them as money. But if you transfer them into current accounts, you can use them as money. So the quantity of money is this number which adds up all the amount of money available in the economy to use at this particular point in time. So what's the price of money? The price of money is often referred to, it's the interest rate. So the price of money is the interest rate. In a sense, it's the opportunity cost of holding money, because if you hold money, what you're giving up is the fact you could be earning a rate of interest on it, not much these days, but you could be earning a rate of interest on it if it was savings, or you would have to pay a rate of interest if you wanted to borrow that money. So the price of money is the rate of interest. It's what you would actually get if you saved money, or what you would pay if you actually borrowed money. And the two things together, are they related? Well, yes, they are. Certainly the Bank of England thinks they are, because the Bank of England thinks it can adjust interest rates up and down, encouraging people to borrow more or borrow less, and that outer circle of those two concentric circles will expand or contract. Equally, you could be in a situation where you increase the amount of cash in the system, a program, shall we say, of quantitative easing, and that will also change the quantity of money. So they're not two separate things, but they do mean two separate things. So when you refer to quantity, it's that money supply, that money stock. When you refer to the price of money, you're referring to the interest rate. So that's the first thing we want to separate, and the first thing that you mustn't be confused about. Now, the next area of confusion is where people refer to the demand for money and the demand for loans. Sometimes those two terms are confused, and someone goes to a bank, I was going to say demanding money, but this sounds like a going to rob a bank, doesn't it? But if they talk about going, I need some money, I'm going to get some money from a bank, when they mean one of two things. They are going to get money from a bank, or they're going to try and get a loan from a bank. The thing about the demand for money is it's quite clear. The demand for money is the demand to hold your own assets in a liquid form, in a form that you can use to buy goods and services. So it's your own assets, the demand for money, whereas the demand for loans is the demand to borrow money from someone else, from their assets, if you like. Now, Keynes, John Maynard Keynes, he identified 3 reasons for you to demand money, and when I'm teaching this, I'll talk to the undergraduates about it, and I will ask them how much money they've got on them today, and they will talk about the access they've got to money through their debit cards and credit cards, and they will talk to actual physical coins and notes that they may be holding. And then I ask them if they've got any more than they expect to use today, and almost all of them have. They've got it. So why are you holding more money than you need today? You're holding money for transactions, but why are you holding more? And eventually we come through to it's just in case. It's the precautionary motive for holding money. You hold an excess of money just in case you need it. Something might happen, and you would need to spend more than you expect. So there are 2 reasons there for holding money. One is transactions, the other is precautionary, just in case. There's a third one identified by Keynes called the speculative demand for money, and this often causes confusion because people talk about the speculative demand for money being using your money to earn a rate of interest, to save it somewhere, to do something with it. That's not correct. The speculative demand for money is holding on to money, expecting that it will increase in value. That's all. I asked my students again, I said, at Christmas, what do you ask for your present from your parents? And we have some nice stories, and some of them ask for money. Why do you ask for money? You ask for money at Christmas because you see that it might increase in value after Christmas. In my day, when I was younger, this was quite clear. Prices were high up to Christmas, and then after New Year, January sales started, and things were a lot cheaper, of course, with Black Fridays and Black Days and sales before Christmas. Now it's slightly changed. But the point was that you would ask for money because you would be able to buy the same thing that you want in a sale after Christmas. So in other words, you're speculating with money. You're holding on to money in anticipation that you will be able to buy more with it at a later date. That's what the speculative demand for money is. So what Keynes said is people demand to hold their own assets in liquid form as money for one of three reasons. One, because they've got things to buy now, transactions. Two, because they want some extra funds just in case, precautionary. Three, they're holding on to money, doing nothing with it, just holding on to money because they anticipate that in the future the price of the products that they want to buy will be cheaper. Those are the three demands. And of course, that's different from demanding a loan from somebody or an institution or a bank or whatever in order to buy something. So never confuse, never refer to the demand for money when you mean the demand for loans. So the demand for money, holding your own assets in liquid form. Demand for loans, wanting to borrow somebody else's assets, reasonably easy and reasonably straightforward. Now, we've already mentioned the price of money, and unfortunately there are lots of theories about interest rates and the price of money, and lots of confusions about interest rates and the price of money. So we're going to go through some of those now. Firstly, we're going to identify some of the main theories involved in determining interest rates. The sort of classic one is loanable funds theory. And loanable funds theory could be explained by those two curves there. We've got two axes, one with the rate of interest on it, the vertical axis, and one with the quantity of money on it, the horizontal axis. And then we've got two functions in the diagram. One is a savings function and one is a loans function. And the savings function is upward sloping from left to right. You will attract people to save more money if interest rates go up. If interest rates go down, they'll hold less savings. So there's a nice slope upward from left to right. Now, the demand for loans is the opposite slope, downward from left to right, because people will be more encouraged to borrow money if the rate of interest is cheaper than if it is more expensive. And therefore you can create an equilibrium point, a rate of interest where the quantity of savings is equal to the amount of money that people want to borrow. Simple loanable funds theory of interest rate determination. John Maynard Keynes, of course, had his own theory of interest rate determination, which was called liquidity preference theory. Now remember, the last one was about loans, loanable funds, but this one is about the demand for money. We've already identified what the demand for money is, and we have the rate of interest again on the vertical axis and the quantity of money on the horizontal axis. And what Keynes said was the liquidity preference, people's preference for liquidity, is their demand for money, and it's downward sloping from left to right. And in fact, it gets to a point where it levels off and becomes parallel to the horizontal axis, what Keynes used to call the liquidity trap, where you couldn't really get interest rates any lower than that. I'll explain exactly what that means in just a moment. So as interest rates go down, people become less and less interested in doing something with money, so they become indifferent and hold on to money. The supply of money, Keynes said, is determined by a central bank. So the shape of this is what's called perfectly inelastic. It's a vertical line. It's determined by the Bank of England, and where the supply of money cuts the demand for money, you'll get the equilibrium rate of interest. And if the Bank of England increases the supply of money from supply 1 to supply 2, then you would expect interest rates to fall. But carry on shifting that supply curve over, and there'll come a point where you won't be able to lower interest rates any further, where people become totally indifferent to whether they hold money or hold interest-bearing assets. So you've got two theories of interest rates, one related to the loans situation and savings, the other related to the supply and demand for money situation, which we've already described the difference between those two, haven't we? And then along comes John Hicks, and he said, let's put them all together And my theory of interest rates is the ISLM model. Investment, saving, liquidity, money supply, ISLM. And he's got the rate of interest on the vertical axis, but what he's got on the horizontal axis is the national income, or the GDP, or the real GDP, a measurement of the total output of the economy over a period of time. And what he said is, as national income rises, as we all become better off, the point at which the supply of money equals the demand for money, LM, increases. So the LM curve is upward sloping from left to right. That is, as people become better off, so they demand more money, holding more money or more of their assets in the form of money, and the point at which you create an equilibrium between the supply and demand for money is upward sloping from left to right. However, the point where you create an equilibrium between savings and borrowing, or what he referred to as investment, borrowing to invest, investment and savings, is downward sloping from left to right. So the interest rate would fall to create those equilibriums as societies and countries become richer and richer. Again, just what economists like, isn't it? Two curves that cross, where you get a rate of interest and a level of national income which creates that equilibrium rate of interest. So that was a third theory, if you like, of interest rate determination. And we're going to take this further, because there are more confusions about interest rates, not only how they're determined, but is there more than one interest rate? Is there a difference between market rates and official rates of interest? We'll look at those confusions. Now, starting with the market rate of interest as opposed to the official rate of interest. Some economists will take those to be the same thing. Whatever the official rate is, that's the market rate. But it's not quite like that. If you removed any official manipulation by a central bank in the rate of interest, and I'll explain what that manipulation is in just a moment. If you remove that from an economy, would there be a rate of interest which would equate things? Would there be a rate of interest which would equate people's savings with other people's borrowings? Would there be a rate of interest that would equate the supply and demand for money? And the expectation is that there would be, and I suspect the market rate of interest would be around 5%, 2, 3, 4% in real terms, perhaps 5% with a 2% inflation, perhaps 6% with 3% inflation. So you're looking at a number for for a market rate of interest which is significantly different from the current official rate of interest. And the official rate of interest is bank rate. And the bank rate is determined by the Bank of England's Monetary Policy Committee. They meet, they make a decision about what the bank rate should be. And the bank rate currently is 0.1%, because we're in a crisis, aren't we? The bank rate is actually what's called the repo rate. It's the repo rate is the rate at which the Bank of England will lend institutions cash. So a sale and repurchase agreement is a repo. So if a bank was short of cash, needed to borrow some cash, it could repo an asset. Now, the assets that are acceptable to the Bank of England are government debt. So if a bank is holding government debt, they can repo that government debt, that is, give it to the Bank of England as security for a loan that the Bank of England will make to them in the form of cash, and the equivalent rate of interest, or the rate of discount on that, will be 0.1%, the repo rate. So you can see it's quite an attractive rate. If you've got a borrow cash short term, it's the best rate that you will get, 0.1%. And the repo, I'll say a little bit more about the repo so you're quite clear. What happens is the bank's got government securities it's bought, so it has the ownership of those securities. Now, it maintains the economic ownership of those when it transfers them to the Bank of England as security on a loan that the Bank of England will give them in the form of cash. At that point, the Bank of England takes over the legal title to these government securities, but it doesn't have the economic ownership. Now, all that means is that if there was a default, the Bank of England can use these to recover the money that it lent, but if there's anything left over after that, that's got to go back to the original owner. Let me make that even easier with a totally different example, which comes to mind as I'm probably not making this particularly clear. If you've got a mortgage on a house, so you buy a house, it's your house, and you've borrowed money in a mortgage in order to pay for that. And when you do that, you actually hand over the deeds of your property to the bank that lent you the money. So the bank actually has legal title over your house all the time you have a mortgage on it, but you have the economic ownership of that. And because you have the economic ownership, any capital gains in the value of your property over the years go to you. But the bank has always got legal title, so if you default on the money you're paying for your mortgage, the bank can sell your house, but it can only take what you owe it, and if it makes any more money in this sale, that money must come back to you as the economic owner. That's all a repo is. It's just transferring legal title for a short period of time while you borrow cash. Now, the official rate underpins, if you like, other rates in the economy, and so we will talk about the impact that the official rate has on other interest rates just a little bit later on in this lecture, but they are two different things. Bank rate, the official rate of interest, is 0.1% at the moment, whereas I suspect a market rate without any manipulation by the central bank would probably be nearer 4, 5, 6%, significantly higher, which is one reason why people who have mortgages should think very carefully about whether they could pay those mortgages if interest rates on the loan went up 3, 4, 5%, a bigger number than they're currently paying. Now, why is the official rate different from the market rate? The official rate is different from the market rate because economic theorists, the Bank of England, are pursuing policies which they think will be best served by manipulating the interest rates higher or lower. And they're not always, in the past, lower. Let's go back to a sort of loanable funds diagram so that you've got an idea of what would happen if the Bank of England does actually set a rate which is significantly different from the market rate. So that little blue dot right in the middle where supply crosses demand would be the market rate. If the Bank of England sets the rate above that, R1, then the quantity of savings will increase, but the demand for loans will fall. So you'll get a surplus of funds in the market with no one to borrow them. So under those circumstances, as the arrows suggest, as the market forces suggest, things will push back towards the middle because interest rates will start to fall to encourage more people to borrow and discourage, if you like, people to save and bring the market for loanable funds back into equilibrium. If the interest rate is lower than the market rate, R2, then the very opposite. People will demand loans in excess of the savings available to finance those loans, which will straight away bring market forces into actions, moving you back to the blue dot in the middle, because you will want to discourage excess demand for loans and encourage more savings to create that equilibrium. So if the central bank set a bank rate which was equal to the market rate, you wouldn't get any distortions in the marketplace. But if the bank rate becomes significantly different from what the market rate would be, then things are going to happen. Not always in the long term, the best of things happens. Now the textbooks tell you that whatever bank rate is transmits to all other interest rates. So there is what's called a transmission mechanism. In other words, the Bank of England is providing the lowest rate at which you could borrow money. So that's going to pull all other rates down. And when the Bank of England put those rates up, so those will push all other rates up. That's not right. That's incorrect. The Bank of England's bank rate does affect one end of the lending market. That end of the lending market is the secure end. So secure lending, it tends to get brought down. But unsecured lending doesn't. I mean, we could make a very simple illustration of that if we took mortgages, which have fallen. So you can probably still get a mortgage for just under 2%. So the mortgage would be under 2% in this situation, but a credit card, if you're borrowing on a credit card, you'll actually find you're paying more on a credit card now, middle 30%, 35%, 34%, somewhere around here, which is actually higher than it was at the time that bank rate was brought down to 0.1%. And when I say brought down to 0.1%, I'm talking about what happened after 2008 and the global financial crisis, when bank rate was 5.75% and was very quickly brought down to 0.5%, and then just over recent months it's gone from 0.5 to 0.1. So that affects the secured end of the lending market, not the other end, the unsecured end of the market. So does the transmission mechanism work? No. The transmission mechanism brings down secured lending rates, and I would argue distorts interest rates. It doesn't bring down all interest rates, and in fact it can have the very opposite at the other end of the interest rate spectrum. It can actually make interest rates higher than they otherwise would have been, which creates an even bigger distortion. Also, at the secured end, you've got relatively safe assets. So you have got property, and you've got shares, and you've got a situation where there is a simple inverse relationship between asset prices and interest rates. If I bring interest rates down, asset prices, property prices, share prices will go up. If nothing else happens, that inverse relationship exists. So at the moment, because you have got bank rate down to 0.1%, you would expect that stock markets are at their highest or very high, and property prices are very high, and that's exactly what you find. That is the current situation. So because it's an inverse relationship, if you put bank rate up and secured lending rates up and push that end of the market back to what I might argue to be a less distorted level, then your asset prices are going to fall. Property prices will fall, and share prices will fall, which is one of the reasons why central banks are a little bit reluctant to reverse a process that they started some years ago as an emergency measure. It was only ever an emergency in 2008 and 2009, and of course that emergency has now gone on for 12 or 11 years, and no sign of it changing. I'll explain why there's no sign of it changing as well in a moment. So the transmission mechanism doesn't work, and worryingly it does create bubbles, prices which are too high for safe assets such as property and such as shares in stock markets, etc. Now, we have an area where people often confuse the terms QE, QT and OMOs. QE is quantitative easing. QT is quantitative tightening. We don't have any of that, so you won't really have heard of that. But I'll explain the difference between those two things and what was and is still called the Bank of England's open market operations. Now, open market operations and QE and QT do exactly the same thing. So we need to identify what's the difference between them. Come to that in just a moment. So quantitative easing was a process of getting more cash. You remember the sort of inner concentric circle. It's getting more cash into the economy when there's concern that there might be monetary contractions and deflation on the way. So quantitative easing took place, which is just the Bank of England buying back already issued government debt. That's going into the markets and buying back second-hand government debt. And it pays for it. They don't want you really to grasp this. And in fact, there's a little pink book you can get if you go to the Bank of England that says nothing about this, whereas it's exactly what QE is. It's printing money. So they buy back government debt with money that they print. Some of it, no, it's just electronic money. They say we don't print it. And of course, the electronic money that goes into the reserves of banks is 100% backed by cash. If they want to have cash, the Bank of England's got to print it. That's why it's simpler to think of QE as printed money. Now, if you thought there was too much cash in the system, you could reverse that process. You could quantitatively tighten. Now, what does that mean? It means the second-hand government securities that you've bought when you quantitatively eased, you can buy back. You can sell back, not buy back. You can sell back into the economy and take the cash out. So you can just go into the markets, sell that, and remove the cash from the open market. That's what QE and QT would be. OMOs, open market operations, were exactly the same. So they've been used for decades. Open market operations are when the bank wants to put liquidity into the system. It buys back some government debt and puts cash into the system. When it wants to take some cash out of the system, it sells that debt back in and removes the cash, which is exactly what I described for quantitative easing and quantitative tightening. So what's the difference between them? The difference between them is that quantitative easing and the quantitative tightening, which doesn't happen, those two things are transparent. Central banks talk about those things in a way to be transparent. They tell you when they're going to do it. Those things are often misunderstood, what they mean, what they do, and why they're doing it, and have unintended consequences because people don't really understand what they're going. There's a nice article, as you can imagine, it's a nice one, it's on my blog, which tells you about how people understand and misunderstand QE specifically. So OMOs, because it does exactly the same thing, what's the difference? The difference is they do it in secret. Nobody knows about open market operations. They just carry on regardless, and the government goes through a broker that we don't know who they are, and they carry out open market operations, less so these days because QE has taken over from that. But that was the difference. And there is a very good argument to say, well, let's go back to only open market operations. Let's stop talking about QE and QT. People won't misunderstand what's going on then, and it will be much easier for a central bank to manage an economy if it just used its open market operations as and when required without any pronouncements that that's what's going on. But I think we've probably gone too far and we won't be able to get back to that situation. But that's a difference that you need to get clear in your mind. Another difference that you need to sort out is the difference between savings and investment. Sometimes people think they're the same thing, sometimes people are quite clear on the difference. And savings are capital protected things. So if I have £1,000 and I want to save it in an account at a bank, that capital is protected. So I would always get back that £1,000. It may not be the same value, of course, because inflation could have eaten into it, or There could have been damage to the nominal value of those numbers, but those numbers come back to me. So if I put £1,000 in a deposit account at a bank, I'll get my £1,000 back, even if, of course, they go bankrupt because of the scheme to protect savings in a bank. So they're capital protected. Investments, read the small print. Investments tell you that the capital value of your investment can go up or it can go down. Investments are not capital protected. So don't misuse the words and use them the wrong way, because it's very important in understanding what's going on now. Because what's going on now is when you've brought down bank rate to 0.1%, you've brought the secured end of the market down, and you've brought savings down to almost zero, what I would call it ZIRP, zero interest rate policy. A ZIRPish number is nearly naught, and if you try and save money, you're almost impossible to get more than 1%, and more than likely you'll get nothing at all. And even talk of you getting negative rates, that is, you'd have to pay for somebody to look after your current account and receive nothing at all. Now, that's quite important, because lots of people rely on savings, particularly if they're thinking of retirement, and they look upon setting aside money into savings accounts that is going to pay them a rate of interest, is going to build value over the years, and then they would use those when they retire. Now, of course, when they look at their savings, they're earning absolutely nothing on them. So what do? They get into investments. Investments, buying into shares, buying into companies, venture capital, lots of schemes which are not savings, not capital protected, and risky. So a 0.1% bank rate policy has almost pushed people out of savings into investments, which is a problem in as much as people don't know what they're doing with investments. And if you've got investments and you have a pandemic, and all of a sudden your £100,000 you had in investments goes down to £70,000, it would have stayed £100,000 if it was savings. Now goes down to £70,000, you feel a little bit let down and a little bit concerned of why didn't you know that was going to happen, and look what's happened to my retirement pot, and so on. But when you're talking about what's going on in the financial services sector, make sure when you say savings you mean capital protected, and when you say investments you're saying something which is not capital protected, and the value can go up and down, and also recognise the problem that we have at present. So what happens if interest rates are too low in an economy? It's good initially. For those of you with assets, property prices start to rise, demand outstrips supply. People say, yeah, property is a great investment, so they want to buy themselves one house, two houses, three houses, and all of that increases property prices and creates a property bubble. Same sort of thing for shares, because people are transferring their savings to buy investments in shares because they see them as the only way they can get a reward in terms of a capital gain or in terms of a dividend, and that increases share prices, which will rise in value and lead you into an asset price bubble as well as a property price bubble. And what you have to worry about there, as with almost all bubbles, there's a jolly good chance that they will burst, and when they burst, then all those people with investments will go, oh, why on earth did I transfer my savings into my investment account? But it's often the case that all those people who don't know what they're doing lose money, whereas all those people who do know what they're doing make money, because when the market is likely to fall, they get out and they hold on to the cash at that point in time, speculating with money, because they transfer their assets into cash and hold on to money until the share prices have fallen, and then they buy them back, because you can always make money with investments whether prices are going up or down, depending upon whether you buy or whether you sell. If interest rates are actually too high, so if they're set above a market rate, then the economy does become unnecessarily depressed. Property prices will fall, asset prices will fall, and banks will find themselves awash with funds that they can't encourage people to borrow at any rate. And so under those circumstances, you might find banks sending you letters saying, jolly good time to borrow money, and trying to shift the demand out for their loans, because the interest rate is not particularly attractive, but they might try through advertising and marketing and letters and even cold calling, encouraging you to borrow money when the interest rate is signalling to you, now probably not a good time for me to be borrowing money. Now the other area, still with interest rates, where there tends to be a little bit of confusion, is between the yield curve and the structure of interest rates. Now the yield curve is something like that under normal circumstances, and the yield curve tells you the yield, dividend, rate of interest, whatever you want to call it, the yield on the same asset, let us say government bonds, with different dates to maturity. So if there's 3 months to maturity, the rate of interest is low, but then as time goes on, as we get to assets which are 5 years to maturity, 10 years to maturity, 15 years to maturity, will never mature, the rate of interest rises. The argument for that is what's called a preferred market yield curve analysis, that people who give up the right to consume goods and services, the opportunity cost of giving up needs greater rewards the longer the period of time. So if you're just giving up for 90 days, you'll accept a lower rate of interest than if you're giving up for 15 years, where you would expect to get a higher rate of return. So that will be a sort of normal yield curve. But yield curves don't always look like that. They can be inverse. They can actually go down in the future, not steadily up like that into the future. And they're called expectation theories. If people expect things are going to get worse into the future, or interest rates are going to get lower in the future, then they might be accepting higher rates of interest yields on their bonds now, but be prepared to buy bonds with lower rating yields into the future. And then there's another theory, we might as well mention it as we're on it at the moment, which is just market segmentation, where you think that there are people out there who want to buy government bonds, and say pension funds want to get into a market where they're looking at long-term purchases. Other people may be concerned with short-term purchase. So in other words, there are more or less separate markets for bonds which are maturing very quickly, as opposed to bonds which are medium-term or long-term. These are just different markets. That's why they're at different rates. But the important point about the yield curve is it's telling you what yield you're getting on the same asset which has longer terms to maturity. The normal shape would look like this, but they don't always look like this. Often it's inverted, and it has been fairly recently inverted because there's worry and concerns about the long term as opposed to the short term. So the yield curve deals with the rates for one asset over longer periods of time. But we have said up to now, we've implied up to now, if you like, that the bank rate, the government rate, does actually sort of determine interest rates. And when there's talk of interest rates, often there's only one interest rate in people's mind, which is the sort of lower end of the secured market. But that's, of course, all wrong. There is a whole structure of interest rates. It's fairly obvious. You know, just look, go out, search the internet, to find out how much it would cost you to borrow money under these circumstances or these circumstances or these circumstances, and you'll find there are lots of different interest rates out there, and that is because of RAT. And RAT is risk, amount and term. Interest rates vary because of these three things mainly. So if you were looking at savings rates at the moment, you find a great spread of savings rates, all probably between 0.01% and 1%, so a little bit of a joke there. They're very low and not much difference between them. But if you look at borrowing rates, then borrowing rates, you're probably looking at a range from, say, 2% to 3,000+%. So you could probably get a 2-year fix on property at 2% or less borrowing money there. But if you go to a payday loan, you might be paying 2,000 or 3,000% when you annualise that rate of interest. So there's a whole structure of interest rates out there, not just the sort of one interest rate that we tend to focus on. And as I said a little bit earlier, one of my girls a few years back did her research on credit card rates, and she found that credit card rates had actually gone up during the period of time that bank rate has gone down. So illustrating quite precisely the distortion that happens by bringing the secured end of the market down, but the other end of the market can be very high. And if you go out to payday loans, then you'll find that rates of interest could be, as suggested there, 3,000% or more. So the structure of interest rates, a little bit like a Manhattan skyline, just look around and you'll find very low rates and very high rates. And remember that often it's the structure which is important when you're analysing things. Don't just think of everything in terms of the official bank rate. That can mislead you. So let's move on to the last real confusion that we need to sort out, and that's the difference between the word intermediation and disintermediation. Banks are intermediaries. Despite what a number of economists tell you, banks are intermediaries. There are plenty of economists out there who say no, they're not. Banks just create loans whenever they want, and all they do is create and destroy money. They don't have to have any savings, they don't have to have anything to back it up, they just create new this and they create new that. Well, that can happen right at the margin, but it doesn't happen all the time, and there is an intermediary function for a bank. Legally, a bank acts as a principal in the market. Now, what that means is it carries the risk. So a bank as a principal will take money from depositors, and it will take the responsibility for that money. So if anything goes wrong, it's the bank's responsibility, not the person who made the deposit. And banks carry out what are called transformations, the transformations that individuals couldn't make if they were lending their money directly to someone. The main transformations that banks carry out is risk transformations, because they're borrowing and lending to lots of different people. The risk is diversified. They can create a maturity transformation, because often when people are depositing at bank savings at banks are for shorter periods of time than people want to borrow. And of course you can make up lots of small deposits and make a longer term loan, and indeed small deposits and large loans. So they transform size, where there are lots of small deposits that make up a large loan, or maturity, where there are people who are borrowing for longer periods of time rather than shorter periods of time. So the bank here is then the principal, and what it does by being the principle is it removes some of the risks that an individual would have if they were lending money directly to someone else, where there is asymmetry. There is a problem of an imbalance of information which a bank can sort out. It can have its people going out there checking credit ratings and carrying out assessments of all the people it's lending to, which individuals can't do. They don't have that information to them. And there's what's called moral hazard in asymmetry and adverse selection. Moral hazard in asymmetry is where you might lend something to somebody on the assumption they were going to do this with it, and they change to do something else much more risky, which risks them not being able to repay you, and you didn't know that that was going to be the case. A bank could find out about that. Adverse selection is where you might lend to someone who you shouldn't have lent to because you didn't fully investigate them or couldn't fully investigate them, and often the person who's a riskier person to lend to is the one who works very hard and is very personable and can persuade you that there's no problems whatsoever, but you might get taken in by that and make a wrong selection, or what's called adverse selection. So intermediation is where the bank sort of removes all of these problems, because the individual just has to make the deposit at the bank, and the bank will look after capital, protect their deposit, at least used to pay them a rate of interest on it, but will at least look after the capital, and if anything goes wrong the bank takes responsibility. That's what intermediation is. It's acting as a principal, not acting, as we'll see with disintermediation, as an agent. So the bank, because it's a large organisation spread over lots of deposits and lots of loans, it has economies of scale that individuals don't have. It can bring down search costs, verification costs, monitoring costs, enforcement costs, and it solves a geographical problem that banks can take deposits in the south of England and lend them to people in the north of England. My apologies. I'd usually have a little joke about all the poor people being up north and all the rich people being down south, which I mustn't say, must I? That couldn't happen for individuals. They don't have that sort of geographical spread, but banks quite easily can accept deposits in one area and make loans in other areas of the country. Let's talk east and west, let's forget north and south. Disintermediation, however, is where the bank is acting as an agent, not as a principal. So when you act as an agent, you avoid risk, rules and regulation, the 3 R's, if you like. And banks can act as agents, and very often do act as agents. I'll explain why in just a moment. There are out there a number of particularly online sort of banking institutions which aren't banks that act as principals, they are agents. That is, they take in deposits, they lend them out to other people, but they take no risk. They take a fee for what they're doing, but they take no risk. So in other words, you make the deposits, but if anything goes wrong, you lose. And because the organisation, it's like Zopa, it's like funding circles, all of these things are getting together savers and borrowers, but they're doing it through an agency, not through a principal. So the agency doesn't take risk, it just brings together the person who's got a surplus and finds the person who wants to borrow it. But banks also are getting into the disintermediation market. Why are they doing that? Well, although they were intermediaries before, they see that there's a growing market for intermediary work, and there are lots of competitors out there. As I said, Zopa, Funding Circle, there's a nice one called Nerd Wallet. Well, there's a lot of nice names out there, entertain you, where they are competing with banks. So the bank is getting in there as well because it's competition, isn't it? At the same time, banks are often bound by rules and regulations, and they could be at the limit of their capital adequacy rules, of their liquidity requirements. At the time that someone comes along and says, can I borrow £1 million? You say, sorry, we can't lend it to you, we're right at the limit. But we could act as a disintermediary here. We do know someone who is sitting on funds that they don't need, and if we put you in touch with them, they may be able to lend you that £1 million. And of course, we'll take a fee for arranging this, and that is disintermediation. It takes the risk off the balance sheet of the bank. It allows the bank to carry on business which it couldn't normally do if it was at the limit of its adequacy, capital adequacy and liquidity requirements. I'll do a whole lecture on that soon so that you know exactly what those words mean. And so we have banks now who were only intermediaries becoming disintermediaries as well. And we have lots of competition between savers and borrowers by institutions which will take the risk of being a principal, and others which won't take the risk of being a principal and only act as an agent. So that is the end of terminology. Just let's sort out what all these words mean. Again, there are a lot of articles on my blog which talk about many of the terms that I've used here and explain things in much more detail. I haven't been able to go into a lot of detail, but I would want you now, whenever we use these terms in the future, to know exactly what is meant by the quantity of money, the price of money, the official rate of interest, the market rate of interest, quantitative easing, quantitative tightening, open market operations, savings, investments, intermediation, disintermediation. And if we know all those things, then we can move on to some of the more advanced work in money and banking in subsequent lectures. Thank you very much for listening.